If you are watching this video, digital banking has most probably influenced you in one form or another and you would like to learn more about it. Today, I will be delving more into digital banking and its future in Singapore. On 28 June 2019, up to 5 digital banking licenses were said to be granted by the MAS to non-banking players. This has not been done before in Singapore and will bring forth endless possibilities of what the future may bring. If you keep up with the news, you probably would have heard of digital banking licenses applied by widely known companies such as Singtel, Grab, N Financial, Razer, and OSIM. Of course, the quote you may all be familiar with. With great power comes great responsibility. To allow for non-banking players to attain digital banking licenses, it is essential for them to meet to certain criteria to ensure that they are suitable candidates. Therefore, MES came up with a list of criteria to select the most suitable companies for Singapore. One of the most important factors I feel for a company to be selected is if they would be sustainable. This also being one of the most important criteria as stated by the MES. So, what does it mean for a digital banking business model to be sustainable and how does sustainability impact the banking business? For a digital banking business model to be sustainable, it is suggested that the four pillars of business sustainability are met. As can be seen from this diagram, the pillars are social, human, economic, and environmental. Firstly, in terms of social sustainability, in which the digital bank can bring about services to serve the needs and wants of customers that will lead to social and economic improvement. Next, human sustainability through improvement and maintenance of human capital in the society. Examples would be healthcare, education, as well as access to services. Both social and human sustainability would be under value proposition, of which the applicants will be assessed by the MES. Next, based on economic sustainability, it is essential that the proposed digital banks will be economically secure as well as have a clear plan towards profitability. Applicants are required to provide their financial projections of the digital bank over the course of 5 years and must eventually lead to profitability. Whether or not the financial projection is valid or suitable would rely on independent external experts. Lastly, environmental sustainability. It will be largely applicable as minimal natural capital would be used to conduct the online business, thus reducing the environmental impact as compared to traditional banking services. You may be wondering, what would happen if any of these pillars are not apparent in the applicant's digital bank business model? The answer would be obvious as the bank would be more susceptible to downfall. It would also likely be the case that the banks without sustainable digital banking licenses would not be applicable due to the limited licenses as well as the extensive selection process. Singapore and Hong Kong are both top global financial centers in the world and are often compared with each other with good reason. Currently, as part of the Global Financial Centers Index as of September 25, 2020, Hong Kong and Singapore are neck and neck, with only one rating difference, putting Hong Kong at the 5th spot and Singapore at the 6th. Banking services are easily accessible in both Singapore and Hong Kong. About 95% of their populations have access to banking services in which they can be classified as highly banked regions. Similarly to the MAS, the HKMA also issued no more than 8 digital banking licenses for their fintech giants only 3 months earlier than Singapore in March 2019. I will now be discussing the influence of such banking licenses being issued on the financial industry in Singapore and how it may affect the competitive landscape between Singapore and Hong Kong. I personally feel that the financial industry in Singapore would flourish when more virtual banks are available as it provides people with more optionality as well as strengthen the competitive landscape in Singapore. By increasing the competition, Singapore is likely to see more efficient and innovative products and services at competitive prices at a much faster rate than before in terms of banks providing a much better customer experience. This will result in banks providing a much This would result in quicker transformation and growth for the banking sector in Singapore. Instead of treating the new digital banks as competitors, the digital banks can also co-develop and co-innovate in increasing opportunity in the market and provide new value in the open banking world. You might be wondering, well then, how would this compare to Hong Kong? Since Hong Kong has access to fintech giants, it will probably put them at a competitive advantage as compared to Singapore. Companies with high market capitalization or big financial institutions like ZA Bank in Hong Kong will be able to provide more attractive rates compared to traditional banking players. In the short term, this will attract many customers and provide brand awareness. The digital banks in Hong Kong also have a very well defined market segmentation, something which is not very apparent in Singapore. To counter that, it will be beneficial for Singapore to build a digital banking ecosystem that focuses on collaboration, thus improving the financial services industry in Singapore. To sum it up, I feel that Hong Kong has an advantage compared to Singapore in the short term, and that a cohesive banking ecosystem will be very beneficial for the financial services industry in Singapore. Something relevant to what I mentioned earlier to building a cohesive banking ecosystem is also included in the eligibility criteria for digital full banking applications in Singapore. As quoted from the MAS eligibility criteria, MAS will not allow any bank, digital or not, to engage in value destructive competition to gain market share. I'm sure that you may be thinking, what exactly is value destructive competition, or what can be classified as value destructive competition? In my opinion, value destructive competition basically means competition that will make an established sector either lose or replace their value, especially when that sector has a lot of value. A prominent example is the taxi industry, where companies like Grab and Uber joined the market, destroying the value of the taxi industry in Singapore. That was detrimental to companies like ComfortDelGro and CityCab. In terms of the financial landscape in Singapore, banks gaining market share through value destructive competition would be very disruptive towards the financial industry. The anchoring positions that the local banks possess would be compromised, thus affecting their significant market share. Rather than disruptors adding value to the banking ecosystem, which would be much more beneficial. All in all, I feel that the decision made by MAS to issue digital banking licenses is generally positive and is essential for the financial services industry to progress, as long as the new digital banks would provide additional value to the banking ecosystem in Singapore. Thank you for your time.